to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, don't miss another incredible interview with Greg Weldon of Weldon Financial. Greg weighs in on the silver shortage that's developing in London, the incredible demand coming out of India for the white metal, whether we've reached a top in gold, and the dramatic shift that's now taking place in the investment world due to what has become a lack of trust worldwide in the U.S. dollar. So be sure to stick around for Mike Meharry's interview with one of our very favorite guests, Greg Weldon, coming up after this week's market update. And if you enjoy this material, please do us a favor and like and subscribe to this podcast wherever you consume this content. It's been an absolutely incredible week in the gold and silver markets, with U.S. retail demand skyrocketing as gold zoomed over $4,000 per ounce and silver broke out above its all-time $50 high. The momentum in these markets has been increasing, and so has dislocations around the globe. As of this Friday late morning recording, gold is up 5% or $200 to come in at $4,233, and that's even after more than a $100 pullback here today. Silver, meanwhile, is also pulling back sharply here today, finally, and checks in at $51.85, good for 2.9% advance for the week, even despite a pretty significant pullback here on Friday. If gold and silver can hold on to these weekly gains over the final few trading hours of the week, this will mark the 9th consecutive weekly gain for both metals. Truly remarkable. As for the PGMs, they too are pulling back rather massively here today, with both suffering triple-digit dollar drops as of this recording. However, at the moment, platinum is still up 0.9% for the week to trade at $1,623. Palladium is up 5.3% to come in at an even $1,500. Again, all these markets are pretty volatile here today, so who knows where they will settle the week in a few hours once most of you are actually listening to this podcast. Now, our listeners may already know that one of the reasons for silver's surge to record levels in recent days has been a shortage of available silver in London. And that shortage, at least recently, has been triggered by some extremely strong demand in India. India's silver market reveals deep structural problems indicative of the broader global market. Simply put, there isn't enough silver, and risks of a major blowup are mounting. Demand for silver in India began to surge earlier this year after the white metal zoomed to new all-time highs in rupee terms. With growing investor interest in silver during an environment when gold seems pricey, a silver supply shortfall in India also sent the price to a significant premium locally. Supply simply hasn't been able to keep up with demand in that part of the world. Initially, Indian buyers were primarily sourcing silver from Hong Kong, but they reportedly shifted more toward London over the past few weeks. This has exacerbated the silver shortage in London. The free float of immediately available silver in London was already down by over 75%, thanks to a recent explosion in silver ETF demand from retail and industrial investors. Large silver shipments to the U.S. earlier this year, due to traders taking advantage of an arbitrage opportunity which resulted from worries about tariffs, have exacerbated the situation. In recent days, Indian traders have been desperately trying to get their hands on metal wherever they can, with many caught short and without physical silver available to meet commitments. At least a couple of major silver funds in India halted acceptance of new investors, citing a lack of metal. However, other investment vehicles are still accepting new funds, raising worries they might be unable to source the needed metal. Meanwhile, Money Metals Exchange just arranged a large shipment of 1,000-ounce silver bars from the U.S. destined for India via Dubai. Bullion banks are engaged in similar operations, standing for delivery of silver on the COMEX and airlifting silver bars to Europe and beyond. However, there's an unusual anomaly in the Indian market. MCX futures are trading substantially below the street price. Business World said this isn't a, quote, small kink, it's a gaping hole in India's precious metals market, and it's getting wider, end quote. One analyst is saying this isn't just normal market stress. It's a signal that someone somewhere can't deliver metal. Overnight financing rates for silver have skyrocketed, further squeezing some market participants. Taking a step back, Remember, the global silver market is on track for its fifth straight structural market supply deficit. Global demand outstripped the silver supply for the fourth consecutive year in 2024. The structural market deficit came in at roughly 149 million ounces. That drove the four-year market shortfall to 678 million ounces, the equivalent of 10 months of mining supply in 2024. Meanwhile, the Silver Institute projects a fifth straight supply deficit this year. When miners can't produce enough metal to meet demand, users must source silver from existing above-ground stocks. But to entice people to let their silver go, the price may need to rise. Last year, there was record industrial demand for silver, but investment demand was tepid. But as the price neared record levels this year, investment demand has surged as well, stressing the market close to a breaking point. And as Business World put it, globally, silver inventories are collapsing, end quote. Concerns of a silver shortage seem to have turned the physical silver market in some parts of the world into a feeding frenzy. And trust appears to be breaking down with more and more players in the paper silver market getting worried it could be hard to get their hands on the metal they think they own. We could see easing pressure in the upcoming weeks as metal moves to the areas of highest demand, but there's no easy fix to the underlying problem, except perhaps even higher prices. Time will tell if India is the straw that has finally broken the silver camel's back. But silver's breakout above its epic 45-year high of $50 is certainly a major event in the precious metals market, and so is the strong reaction from retail investors. What happens from here is unknown, but you can be sure we'll be watching closely and reporting on what we see. Well, now, for more on the recent action in metals prices and a whole lot more, let's get right to our exclusive interview with one of our very favorite guests.
Greetings, I'm Mike Meharry, an analyst and reporter here at Money Metals, and I'm thrilled to be joined once again today by Greg Weldon. Greg has a long resume, and I'm not going to read all of it, but it includes stints as a floor trader, an institutional futures broker, a hedge fund manager, CTA. He's the producer of independent global macro market research, and an all-around nice guy. How you doing?
Doing great, man. How about yourself?
Doing well, man. I tell you what, it's hard to even know where to start with everything that's going on in the precious metals markets right now. So let's just kind of start with the basics. We've seen this rapid rise in both silver and gold prices. Today, we've had gold over 4,300. Silver broke 54 today. And I'm starting to hear some people out there talking about bubble, oversold, overpriced. Do you think gold and silver are in bubble territory right now?
Man, I mean, that's the $64 million questions. I have actually clients that are gold bugs calling me, and I don't consider myself a gold bug. I'll be long, short gold. I'll be bearish. I don't care. I'm not a perma bull. But they're calling me now and wondering whether they should liquidate. And I find it interesting because you could absolutely suggest it's a bubble. I mean, just based on the price increases. On the other hand, you could say this is still early stage. So this is what makes it very difficult here to try and determine what's happening. I would go back to the drawing board almost and ask ourselves first, how did we get here? All right. It's not a speculative fervor yet. It just isn't. This is still open interest in the futures contracts. Pretty dang low. I mean, it really hasn't expanded that much. This was, the catalyst for the move that we're seeing now was, in fact, BRICS unit buying, countries that were dumping dollars and taking those dollar proceeds, buying gold, having the gold shipped locally, draining the vaults, you had some tightness, so on and so forth. You could make a case that this is the beginning of the unwinding of the great paper shorts in these markets that have been manipulated for a long time. That has a ring of truth to it as well. But then I would say, look, this move has not been driven by any kind of serious or severe decline in the dollar. It's not speculative in nature. You've had gold and other currencies triple or quadruple in those currency terms. We haven't seen that in dollar terms yet. So you can make an argument either way. You really could. So it's almost like this is a day-by-day thing. And we got stopped out of our silver positions. And as futures traders, when you're talking about $50 silver and having $3 moves a day, one contract, that's 15 grand a contract. Even me, our minimum account size is $1 million. I don't risk 1.5% on any one trade. I want 0.5% of risk, and that's tough to find here. So It's made the markets much more difficult in terms of managing the risk. So the question of whether it's bubblicious or not becomes even more important, because you could get scalped here if it is and you're wrong. I would say that a couple of things. Number one, I did a recent report, and I'm happy to send any of these recent reports to your listeners, called in something else we trust. All right, it's always kind of been in God we trust, and on the dollar bill it says in God we trust, and we're not. Look, God is not paying us back $36 trillion. Okay, it just isn't. So really, it's in the dollar and in the U.S. Treasury and in the U.S. government that we trust, but we don't anymore. I mean, how long have they lied to us, whether it be alien cover-ups, the Vietnamese War, this whole dynamic around weapons of mass? It doesn't matter, all right? They don't really tell us the truth. And what they've done is, borrow $36 trillion in the name of we the people. We owe that money to ourselves. We also have bought $28 trillion of that debt ourselves. We owe this money to ourselves. And what they've done is, you look at the budget numbers. In the last fiscal year, there were 3 months where they spent twice what they took in. It's become so irresponsible in terms of the spending and how they lie to us about where the spending is going, and how Trump has uncovered some of these things around how really superfluous this spending has been and how wasteful this spending has been. It's a lack of trust in the dollar. Not only that, it gets all the way back to Bretton Woods, the rights of seniorage, and the degree to which this trade bullying, and honestly, you need something on trade. You need to do something about it. And some bullying tactics were valid. But the degree to which you have used these tactics and reciprocal tariffs and trade sanctions and asset seizures have pushed people away from the dollar, when this is already happening naturally, because China is 3 to 2 times average monthly trade dominance in the world over the U.S. now. All right. So to suggest that maybe trade should be priced in renminbi is not really that outrageous, because they're the major trader in the world. All right. So this all ties back to the BRICS and how we don't hear about it much anymore. But if you don't think in the back rooms in these countries that they're not pushing harder and harder and have more of a sense of urgency to get this done, you're fooling yourself. OK, because the trust in the dollar is faltering here. And that, to me, is the biggest thing. What are you going to trust in? You're going to trust in stocks? Corporate America lies as much as does the government. I mean, it's ridiculous. You can't trust anybody anymore. I mean, I always go back to the Verizon phone, and I like Verizon. It's one of the better companies, frankly. But when I buy an unlimited package for my daughter, who is now streaming movies from her phone instead of getting cable, and I get it with a $900 usage bill for data, and I said, but I had the unlimited package. And I'm not kidding you when they told me, well, you have unlimited, but you don't have above unlimited or beyond unlimited. And it's like, wait a minute, do you know the meaning of the freaking word unlimited? All right. The advertising on TV is just so out of control. Everything, the chaos, the politics, the violence, these cities where they can use taxpayer money to house illegal immigrants. It's insanity, man. Why would anyone trust the dollar right now? We're the world's biggest debtor nation. We're pushing people away from it. So from that context, I would say no, it's not a bubble. And no, silver at $54 is on its way to $100. And no, this is still really early stage. So you can make a case either way. The risk would be, if you have a meltdown in stocks, that all asset prices get sold. And now you are in the territory where there is enough money in gold and silver, especially in the mining shares, where if stocks were to get hit, and I think you're very close to a major sell-off in the U.S. equity market. We can talk about that. I call it the Tom Cruise market right now. If you remember the movie Mission Impossible, where he's hanging by a few fingers from a cliff, that's the U.S. stock market to me right now, right? You don't have the consumer. There's no, the XLY, the XRT. These things are breaking down relative to the S&P 500 and have not confirmed the new highs. This is AI chips, very narrow, and this dynamic is not sustainable in terms of the underlying economy, where a consumer now, spending, the consumption expenditures are more than disposable income every month now. You're talking about savings that is less than credit card debt. You're talking about delinquency rates that are second highest in history, behind only 2008, 2009. And you're talking about the third only year-over-year 12-month revolving net change negative in revolving credit. And the only other times were the pandemic in 2008, 2009. So to me, to suggest the stock market here is going to keep plowing higher, you need a lower dollar. And right now, the dollar's not declining anymore. So to me, that's the risk for metals here. And I do believe you will have some sign and some little sliver of time if you see the equity market kind of begin to sell off. And frankly, believe it or not, to me, Bitcoin could be a leading indicator for the equity market because it's been equitized, okay? You remember Bitcoin, I think I've said this on your show before. Originally, Bitcoin was like, we don't want to be the dollar, we don't want to be gold. But we're going to symbolize ourselves with a gold coin with a B dollar sign. I mean, come on, give me a break. Then it's like we don't want to be regulated until people got hundreds of millions of dollars of Bitcoin stolen. Now we want regulation. They said they don't want to be mainstream. And now they're an ETF, and everyone owns it through ETFs, all right? So to this degree, the correlation between Bitcoin and the S&P 500 has become extremely tight, and it has become a leading indicator. So if you look at the consumer, look at Bitcoin, you look at what the bond market, of course, has done, which really hasn't impacted stocks at all, where in the past, the 5% 30-year would have mattered. I think there's a lot of risk to stocks, which then imposes some degree of risk on the precious metals. But to say it's a bubble that's about to collapse and it's going to be over, I don't know, because you remember what happened in 2008. Yeah, gold went down 25%. That was a lot less than stocks did, and gold bounced back first and ferociously. I kind of could see some kind of scenario like that. So to me, it's either, bubblicious and you'll have a great buying opportunity, which is kind of part of what I hope for, because who's going to buy it up here? The risk is too big.
Yeah, that all absolutely makes sense. It's interesting to me, thinking about the kind of bubble term. It's interesting that a lot of the big banks, the Goldmans, the BOAs, they're upping their gold forecast for next year now. Now, of course, part of the problem is that the gold price has already surpassed a lot of those forecasts.
Right,
but they, the mainstream still seems, they're not screaming bubble. So, what do you kind of make of that, of this mainstream scramble to kind of up these forecasts?
Well, you have seen this, and it's an interesting point, because there was a day last week where I finished working and I was on the couch and I had Bloomberg on. I fell asleep for a little while and I woke up. And when I fell asleep, there was someone from one of the major banks talking about gold at 4,000. Just before it hit 4,000, it was still like 3680-ish or so, still below 3,700. And I woke up and I swear to God, there was somebody that was a specific, like at a stock market house that has really nothing to do with even macroeconomics, right? Not a bank. And there's a woman on who was young, and frankly, she kind of didn't know she sounded to me like she didn't have a lot of experience, frankly. And she was talking about gold at 4,000. Everyone needs to have gold. Now, if you were to have, and we talked about this last time we were on, and probably the time before that, maybe even the time before that, we could talk about it all year, that this would be a market where you would have a rotation of Wall Street money come in. We've seen that in the mining shares. They have outperformed even NVIDIA, for crying out loud, in most recent period of time. And I said, if you remember, that people end up chasing this market higher because they don't own enough. And they're kind of in that phase now. The question is, how far does that go? But the degree to which, when this woman comes on and starts talking about gold at $4,000 and this, that, and the other thing, it was one of those moments where it was just like, oh, shit, like maybe this is the problem, that this woman is bullish on gold now. And I'm not kidding you. Within a half an hour, I got a text from my largest money management client, guy with a lot of money with me, wanting to know whether he should start liquidating his mining shares. And that, to me, was kind of a tell. I have this kind of gut feel, and this guy calls me. He's a really smart guy, and I'm seeing this on TV. It's like, okay, well, the taxi cab drivers in New York must be day trading gold, because, this is kind of like one of those anecdotal kind of instinctual signs. Of course, then gold went $200 higher, in a very, short period of time. So I think that it probably has higher to go. But the risk here, you can't buy it here. If you're not already long, you can't buy it here, to me. That's the problem.
It's interesting to me. I think back just not really long ago, maybe 2 years ago, if you talked about $4,000 or $5,000 gold, that was tinfoil hat stuff, and all of a sudden it's like. I mean, I've been, I remember in 2008, 2007, I wrote my book on gold, okay? And it was trading around $420. And you remember in 2007, and I said the Fed will monetize government debt, which was considered monetary heresy at the time. You were a nut job if you said something like that. And I did a book tour, and I was on Squawk Box with Kernan and Mark Haynes at the time. And I said, yeah, the Fed will monetize debt, and gold will go to 1,200. And Joe Kernan called me a nut job on national television. Like one of these guys that says the Fed's going to print money and gold's going to quadruple in price. And guess what happened? This is exactly what happened. Yeah. Sometimes you got to wear the tinfoil hat if you're going to see the future and have a vision outside of the norm. And you can never dismiss any possibilities
in terms of how high prices can go. I always say this.
Yeah.
We've seen it in coffee, we've seen it in cocoa, we've seen it in OJ, and now we're seeing it in gold and silver.
Yeah, it's funny that you mentioned the monetization of the debt. I just wrote an article today where I referenced Ben Bernanke back in 2008, sitting in front of Congress, swearing that, whoa, no, we're not monetizing the debt right now. We're this is temporary. Here we are 20 years later.
And that was a big turning point when they did that in 2008, because what happened? This is when we entered the debt black hole. I've talked about this before too. It's pretty simple. It's a simple thing, but it's much more complicated. But if you look at, if you look at U.S. public debt, we're not even talking household debt, which adds another 18 trillion onto the total. And then you look at GDP. I mean, you've been pretty steady, for decades in the growth in the two until 2008. When they started monetizing debt, you pushed the debt above GDP. And now you're about 185% if you include household debt. I mean, that's crisis levels, and yet the dollar's held up really well. So the bigger picture story in gold, if it's not a bubble, would be the dollar gets whacked, all right, when the Fed comes back in, because they will. And this is where, to me, the Fed's making a policy error already, all right? The data we got today, for example, from the Philly Fed, or the most recent CFO survey that the Richmond and Atlanta Fed do, very clear in the sense that the spending that these firms are now doing is increasing pretty dramatically, and it is to reduce or replace labor. And when you have a consumer that's already cocooning for all the reasons I just said, and you're going to throw the labor market in there in the mix, and you talk about 1.3 million people over age 65 that are dropped out of the labor force. You talk about 2 million people that are not coming in from immigration. You see this in the number not in the labor force on a rolling 12-month basis, hit 3.219 million in July. Never have we been above 3 million without some kind of recession. And when you have all these things where the consumer is already hurting, the Fed should be neutral now, because you have housing, you have the consumer, you have the labor market, now potentially even the stock market, which will probably be the catalyst they're going to need, all right, to at least get to neutral before inflation rises again, because it's going to. So if you're already neutral and inflation rises, you actually get a little stimulative because real rates are dropping, as opposed to we waited too long, now inflation is rising and we can't cut rates, without it becoming something out of control. Yeah. So I think the Fed has kind of lost control of their own destiny here by being too timid. And I think that's a problem too. And that's bullish for gold.
Yeah, absolutely. So let's talk a little bit about silver specifically, because I think what's going on in the silver market right now is really, really interesting. Of course, we're hearing about metal shortages in London. Is that jiving kind of with what you're seeing as well?
Sure. I mean, this is kind of the denouement of this decades long. If you remember, you may remember, and you might be able to tell me, was it Bill Williams or whoever used to debate Dennis Gartman on GATA? Do you remember those times back maybe 15, 20 years ago?
I remember GATA.
It was like 1999 when the Washington Accord hit, and they decided the central banks were going to stop selling their gold after the Swiss dumped their gold, and the Bank of England dumped their gold. And there was this big debate over GATA and whether the bullion banks were in fact, big paper shorts in these markets.
Right.
So the silver squeeze, hashtag silver squeeze, and that's a real thing, man. I mean, it's just something that didn't matter until it matters.
Yeah,
it looks like now it may matter.
So. That hashtag's trending now. So, what in your view is causing this disconnect we're seeing right now between New York futures and London spots? And do you see this normalizing anytime soon?
I can't really put my finger on it other than that this is movement of physical metal. I mean, so to me, that speaks volumes to a bullish underlying scenario that's not going to go away anytime soon. And that's why if you do see the stock market crack and it does bring prices down, it might be the last great generational buying opportunity. Yeah. So that's something I keep in my back pocket to see how this plays out, because, man, handicapping this market, I've been doing this 42 years, and I started on the Florida gold and silver pits. I mean, in the silver pit, literally, for 3 years. And I've never seen it more volatile, more uncertain, and more, difficult to handicap. It just is. It's really tough.
Yeah, it's wild. There's such a shortage of metal in India right now that Indian firms are actually sourcing metal from us, from Money Metals. Yeah. We sent a bunch of 1,000 ounce silver bars over there just a couple of days ago. So kind of gives you.
Let's consider it this way. Think about it this way, because if you remember, okay, it's kind of interesting. Really, we could tie this together. Just recently, we were talking about, where was the overhead resistance, where it would be the breakout point in silver, and it was 36.50. Specifically on your show, like if it's through the 36.50, you need to own it because this is what's going to happen. Remember, I said it's not will it get to 50, it's how fast will it get to 50, and that's exactly what's happened. All right, and I said at the beginning of the year, you'll chase this market higher. It's exactly what's happening. But think if you asked yourself, when gold went from $35 when they unleashed it to 110, was it expensive? No, sure as heck wasn't. Does that mean silver at $100 is expensive? Yeah, maybe not. Maybe not at all. Especially when you think about copper and silver and all the potential uses down the road for technology and all the different things, and even some of the properties we're not even sure we yet understand that apply to something like gold. So to me, the upside is much greater than the downside. But for sure, because prices have rallied this much, the downside has expanded potentially in terms of risk.
So my cohort, Josh, asked me to ask you this. He said, is the oscillation of precious metals, this movement of metal between countries that we're seeing right now, is this a sign of something more ominous in the making?
Yeah, no doubt. Absolutely. And it gets back to trust in the dollar, because it's not just trust in the dollar, it's trust in every currency. And I mean, this is problematic. If you have a situation where central banks have to address, to me, it's stagflation. It's all over the place. I mean, it's written even in the Philly Fed data today. Stagflation was glaring in that report. It really was. When you talk about the labor market dynamic and how it's a hollowing out of the labor market. You remember that phrase in the 80s?
I do.
Hollowing out of the U.S. industrial economy.
Yep.
You've had the same thing here with the hollowing out of the U.S. labor market has taken place. We've seen hollowing outs various steps along the way. Even going back to when the internet was created, and you had price discovery, and that was a big deal. And you had a hollowing out of kind of commodity prices and inflation to whatever extent. So we see that happening too. And in that context, this happens everywhere, and we're seeing this everywhere. And what happens in those cases? Silver, gold, they become strategic metals in terms of backing your country, in terms of ability to maintain trade even. Can you imagine a scenario down the road where, it's not the BRICS unit, it's not the dollar. It's like, we want gold or silver if you want to trade with us. That's not outrageous to think about. It really isn't.
No, it's not at all. It's interesting. I saw, and actually I kind of summarized an article that I saw about Italy, and Italy has the third largest gold reserves in the world, and they're sitting pretty right now, whereas Spain, England, a lot of those other European countries, they sold all their gold holdings. So it's kind of just...
Yeah, and do you think that Italy's going to sell some of their gold to them? And Spain says, well, we're EU partners, we need some gold. It's one of those things, like you watch some of these post-apocalyptic TV shows where you have all the clans and they're always fighting each other and they have alliances and they break up the alliances and stuff. But it's like, this could become the currency in global trade going forward. And when you talk about Joshua's question, he's obviously a really bright guy, and it's a really good question. To me, ominous is the word, because to me, everything makes this look ominous. The irrational behavior in markets right here makes it ominous, and that particularly applies right now to the U.S., Germany, some of these stock markets. But I mean, the U.S. stock market to me could be the next big move, and that's going to really put a whole new monkey wrench into the entire picture.
All right, I'm going to get you out on this one. This is a little bit of a shift in subject, but I want to talk a little bit about the tariffs and the threats of tariffs, and how is this impacting the markets, particularly in commodities? And I guess the specific question is this kind of, it seems like there's a movement with U.S. policy toward deglobalization. Is that good for the U.S.? And what about investors?
Yeah, I would say it's good for the U.S. on a relative basis in some cases, and bad for the U.S. in relative cases otherwise. What I think that's good for is China, Russia, and OPEC, and the triad of the powers that be on the other side of the world now. All right, I really do. And this is something that's been trending since 2018 when they opened the crude oil market. They chose to Dubai OPEC grade. They priced it in renminbi. They got benchmarked, Russian oil crude against it. That was the beginning of the end for the dollar. So when you kind of look at it from that kind of perspective, I would say that, yes, this is much bigger picture in that vein. What was the exact question again? Because I kind of started thinking about China and OPEC and the other side of the world and the power.
Is deglobalization? Is it good for us?
It's bad for the U.S. We're the biggest debtor nation. It's very bad for the U.S. It's bad for the dollar. It puts us in a position where, gold could be $10,000, $15,000 an ounce. Why? Because the dollar's getting devalued all the time because nobody wants to own it. And the Fed is having to print so much money that it begins to look like many of these emerging market countries that have huge amounts of debt. They devalue their currencies all the time. Stock market makes a new high. I say this all the time. Argentina, the Merval, makes a new high all the time. You think the standard of living is better in Argentina? Absolutely not. Yeah. What it's bad for, I will say this, what it's bad for longer term is the standard of living in the U.S. and frankly, around the world. I mean, it's unfortunate, but we have lived above our means for so long and created so much debt. I go back to the great Bill Bonner, in the day of reckoning. I mean, that comes closer and closer. And ominous gets back to the word that Joshua used, that I used the other day. This just feels ominous, and it feels that way to me. It feels heavy. It feels like something is about to blow. Something big is about to happen. So in that case, I don't think that bodes well for the U.S. at all.
Yeah, I agree with you completely. That's my sense too. This is all signaling. We can look at the prices and we can look at some of the specific things and we can look at central banks buying gold. But it's really important for people to grasp that this is I think a fundamental shift that we're seeing right now in the global financial system. And who knows what the ramifications are going to be at this point. And I think we just have to
something else we trust. Yeah. People want to trust in something else than they've trusted before, and that's a major shift. And I 100% agree with what you just said.
Yeah, absolutely. All right. So before I let you go, I do, as always, want to let folks know where they can avail themselves of your information, your website, all of that stuff.
Done a couple of really good reports lately on the U.S. Today, I just did the Tom Cruise market, of course, hanging by a couple of fingers on the rock. Done a couple of other ones. The debt black hole, of course, is one. And then in something else we trust is a big one. So when you look at those things, I'd be happy to send those reports to anyone. Get you on a free trial of my research. It's Greg Weldon, GregWeldon, at Weldon online. You can follow me on Twitter at Weldon Live. Always posting some good stuff on that. I like to post articles from Bloomberg or whatever and tie it in to kind of the more odd nuances of what's going on and how we can navigate these things, more efficiently, given how complex and how really difficult it is to do that right now. And of course, I am a CTA registered Series 3. We do manage money. Our minimum account is $1 million. And people say, why so much? It's like, well, now you're starting to see why so much, because, the gold contract is going to be $500,000 unto itself at any moment. So any information on that, we have really, since we put this new program together in the beginning of 2018, on the back of China creating a crude oil market, on the back of all of this leading to higher inflation, into a whole different monetary paradigm and the whole dynamic around what you just said, a bigger shift. The program we're executing right now is designed specifically for this, and we have really kicked butt. I'm a humble guy, but the numbers are the numbers. Happy to show you the numbers. Just shoot me an email, Greg Weldon at Weldon Online. Of course, we also do the podcast, which is free, Money, Markets, and New Age Investing, hosted by Buzzsprout, but available everywhere.
Well, you are fantastic. You're a benefit to the world, and I always appreciate having you on, not just because you reaffirm a lot of the things that are going through my head, but just that you have such a good sense of the bigger picture, and I think a lot of folks out there in the investing world miss that. They get tunnel visioned on minutia, and I like the way you always bring things back to these big pictures things, the debt black hole, losing trust, those types of things, and that's really important. So thank you so much for spending a little time with me today, as always, and I'm sure we'll have you back on again soon, and just keep up the great work.
Thanks, Mike. You do a great job there too. Money Metals and Joshua, you all are fantastic, and people are lucky to have someone like you out there, promoting their best interests.
Well, I appreciate that. Have a good day.
Take care, man.
Tremendous stuff there from Greg Weldon once again. Definitely one of our very best guests, and I trust you enjoyed that thoroughly as I did. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. And don't miss our second weekly podcast, the Money Metals Midweek Memo, hosted by Mike Meharry and available each Wednesday. To check out any of our audio programs, just visit moneymetals.com/podcasts or find them wherever you listen to your favorite podcasts. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.